Hello, everyone, and thank you for joining us today for the first OIC webinar in March, where it is Greeks month. I'll be presenting both webinars this month, and both of them cover the topics of the Greeks. Today's March 8th, and today's topic is going to be the Greeks 1, which is an overview of Delta, Gamma, and Theta. Next week on the 15th, I'll be presenting the second webinar of March entitled, you guessed it, the Greeks 2. That's going to cover Vega, Rho, and the second order Greeks. So make sure you mark your calendar for next week as well. The combination of these two presentations should really help to build your base of knowledge surrounding some of the conceptual pieces of options risk that we refer to affectionately as the Greeks. My name is Matt Cashman. I am the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. Just to give you a little bit of background on myself, I started trading around 1998, and I've been an options trader ever since. I got my start in Chicago on the floor of the CBOE, trading equity and index options. Pretty quickly after that, I moved to London and traded interest rate options there. And I eventually moved back stateside, where I started and ran an index options market making operation for the better part of about a decade in Chicago, again on the floor of the CBOE. Currently, I work at OCC helping individuals and investors to better understand both the risks and the benefits of exchange traded options through efforts like our webinar today. Now, we always include a disclaimer to make the lawyers happy. Options involve risk. They are not suitable for everyone. Any strategies discussed, including examples using actual securities and price data, are strictly for illustrative, educational purposes, and should not be construed as an endorsement, recommendation, or solicitation to buy or sell securities. Past performance, as always, not a guarantee of future results. Now, one other tiny bit of housekeeping. The following trademarks, logos, and service marks displayed are owned by the Options Clearing Corporation, and you will see them used throughout the presentation today. Let's talk a little bit about OIC. Options Industry Council. The Options Industry Council is the educational arm of our parent company, the Options Clearing Corporation, or the OCC, which is the largest clearing corporation of equity and index exchange traded options in the world. OIC started out as a collective in 1992 to better educate the public as to the risks and benefits of exchange traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, which you'll see right here, optionseducation.org. It's a fantastic resource where we host all of our educational material. I highly recommend you checking that out. There you'll find online courses, podcasts, videos, and webinars like the one you are listening to now. We are able to provide these services free of charge to the public because we are fully funded by our parent corporation, the Options Clearing Corporation. Thank you very much, OCC. Now, I work on a fantastic team at the OIC. We call it the Investor Services Desk or the Investor Education Desk, where I sit with three other colleagues, two of which are answering your questions via the chat today during our presentation. Make sure to say hello to Ken and Roma when you ask questions, and be patient, as oftentimes lots of questions come in at the same time. They're going to do their best to get you an answer as the webinar is happening. If you don't get an answer to your question today, you can always send us email questions related to options at this email address, options@theocc.com. This, again, is a free service that we provide to the public as well. It's important to note we are not registered investment advisors, so we can't direct you on trades or suggest investment strategies, but we can help with general questions about options, about optionality, and the theoretical knowledge surrounding the options ecosystem. Amongst the four of us that sit on that investor education desk at the OIC, we have over 100 years of industry experience, either in the brokerage side, on the brokerage side of things, or on the trading side of things, all surrounding options. And we are always happy to help in whatever way we can to further advance your understanding of options and how to responsibly use them in your investing by leveraging all of that experience that we have amongst the four of us. So that's OIC and a little bit of background on me. Let's dive right back into some information. This is a graph of annual options volume from 2000 to 2022. We really consider this to be the modern era of options trading. It encompasses the advent of high frequency trading over here, right around the change from 1999 to 2000. And as you can see, there's been an absolute explosion of options interest over the last roughly 2 decades or so. Much of that volume and that explosion of volume has come in these last 3 years, 2020, 21, and 2022. 2008, if you go way back, 2008 was obviously the great financial crisis. I was standing in an index options trading pit on the floor of the CBOE at the time. I remember seeing something like 3.7 billion contracts hit the tape at the end of the year and thinking that I would never, ever see volume numbers like that ever again. I was so wrong about that forecast, as I was about many other forecasts. However, once we hit 2011, we saw the advent of the sovereign debt crisis across the globe. And likewise, another volume milestone was followed in 2018 when OCC cleared a record 5.2 billion contracts of exchange traded options. But we have never before seen what has happened in the last 3 years. This is a sustained explosion of volume spikes for 2020, 2021, and 2022, brought on by many factors, including the sustained volatility of the markets throughout COVID-19. But we're also seeing these volume numbers be much more sticky, I think, than anyone forecasted to begin with. And so from my seat, from an educator's seat, from the seat of the person who's doing a lot of the education as far as options in the marketplace, it means that what we do at OIC from an educational standpoint becomes that much more vital to a healthy, functioning marketplace. So we want people to come into the marketplace with as much information about options as they can get their hands on, so that the actual decisions that they're making based on what they know are informed decisions, and that they don't walk into a situation where they end up making trades that they don't have a lot of information to back up and end up doing something that they didn't mean to do, or thinking that the options were going to do something that they just can't theoretically do. And so it's really important from our seat that what we do from an educational perspective is really vital to what the actual marketplace does on a daily basis. So with that said, let's dive right into what we're going to talk about today. So first thing we're going to do is talk about the Greeks in general. I'll give you a general overview. We're going to talk about delta, gamma, and theta. And then we're going to have a little bit of Q&A if we have time, hopefully. Let's dive right in to the introduction to the Greeks. So these are what we consider really 3 of the kind of headline first order Greeks. Now, I say that they're first order Greeks. Some of you out there are going to know a lot about options and tell me this one, obviously, gamma is not a first order Greek. Technically, gamma is not a first order Greek, but it gets lumped in with all of those first order Greeks that most people look at generally. If you talk to most professional option traders, they're going to tell you that the Greeks that most people look at are going to be the top 5, which are delta, gamma, theta, vega, and rho. We're going to talk about delta, gamma, and theta today. Again, on the 15th, we're going to talk about rho and vega, and then we're going to talk about some second order Greeks. So these are really the kind of headline Greeks that people generally have up on their risk screens. Delta, let's start with, is the expected change in an option's value with respect to the changing underlying stock price. So the delta of an option is going to tell you how much theoretically that option's value should change for every dollar that the underlying price moves. Gamma is technically what I said. It's the first derivative of delta, so it's a second order Greek, really. It is the expected change in option delta with respect to the changing underlying stock price. Notice the difference here between delta and gamma. Delta is the expected change in the option's value. with the underlying stock price move. Gamma is the expected change in the options delta with respect to the changing underlying stock price. So those really speak to two different things, although they are, one of them, gamma, is derived from the first one, delta. The third one we're going to talk about is theta. This one's a little easier for most people to understand. It's the expected change in an option's value through the passage of time, or time decay, as most people refer to it. It's basically how much you think this option is going to decay over a 24-hour period of time. If you are to fast forward your clock one full day, theta is going to be the force that actually decays, theoretically, that option over that 24 hours. Here are some things that you might hear coming out of an options trading pit. What is your delta? That might be one trader asking another trader what their delta is. What they're really asking each other is, what's your exposure to the movement in the underlying marketplace? Are you long or short delta? So you can hear people say that. Another question that you might hear some people asking, how much gamma do you have on? What that is someone asking another person, how much can you expect your position to change if the marketplace moves? And how quickly does that change happen? We'll talk about that as a theoretical construct a little bit farther into the presentation. And then another thing that people might ask, how much theta are you collecting or paying? In the parlance of the actual professional option trader, most people talk about theta as either collecting or paying. Collecting theta generally is spoken about as you being short options and thus having a positive theta number. Now, it's not always that way. It's not guaranteed. And as we'll talk about later on, theta itself is not always guaranteed. There's lots of dynamic forces at work in the marketplace. But when people are talking to each other about their Greeks, they might say something like, how much theta are you paying? If you're paying theta, and the way that people talk about it in those terms, you generally are probably long options, and you are paying an amount of decay over the next 24 hours because those options theoretically, according to your model, are going to decay at that rate over the next 24 hours. That's theta. So those are some of the things that you might hear people talk about and ask questions about with each other, and how they use these terms to actually transmit information about their risk back and forth. Let's talk about the nature of the Greeks and how they exist and how they can actually affect each other. So Greeks generally are meaningful only during an option's lifetime. At expiration, they disappear, they become irrelevant. We get a lot of questions about what happens to my Greeks when my options expire, or what happens to my Greeks once I exercise these calls. The answer to that question is, if you don't have options on your sheets, you don't have Greeks. Greeks only exist because of the options that you hold in your portfolio. So at expiration, if your options disappear, your Greeks disappear. Or if you exercise your options and convert them to an underlying stock position, again, if you don't have the options anymore, your Greeks also disappear with the options changing into an underlying position. Greeks can affect each other. A change in an option's theta or time decay may affect its delta. These things can be interdependent on each other. That's one of the things that people, as they start to learn more about the Greeks, they start to realize, and you start to utilize these kind of pattern recognition things where you're able to see how over time, as you see certain Greeks go up in value, you also see other Greeks go up in value commensurately with it. And those things kind of become more and more clear to you as you see different iterations of this happen, okay? Also, the impact of a change in Greeks can be different depending on the type of option that we're talking about here. Take, for example, in the money options versus at the money options and out of the money options. They have different and varying levels of delta, gamma. They also have different levels of, for instance, vega in certain circumstances. Additionally, longer term options. Now, this is something we're not going to necessarily cover in depth today, but we will on the 15th. Longer term options always are more sensitive to movement and implied volatility because they have more vega in them. They are vega rich options when they increase in duration. Shorter term options generally have more gamma in them and less vega in them. But it's really important that you understand how these options exist as far as the Greeks are concerned and how they're interconnected with each other. Near-term versus long-term options, and in the money versus out of the money versus at the money options. We'll talk about all of those things within this presentation today. And again, we'll touch on some of those things on the 15th as well. As far as the Greeks are concerned, there is one metaphor that I like to use, and that comes along with a little bit of a story that I'll tell you very quickly. The metaphor of the Greeks that people like to use sometimes is that they're like a dashboard to your car. Now, before I tell you about this metaphor, I want to give a shout out to Ken Keating, who is in the background answering questions right now. This is actually his metaphor that I have unintentionally co-opted into my teaching style. But when I first started at OIC, which was probably about a year and a half ago, one of the first presentations I watched was Ken doing a presentation on the Greeks. And I think he used this metaphor as option Greeks being like a dashboard in your car. And I completely unintentionally co-opted it into my presentation style and have used it ever since. So shout out to Ken Keating. But here we go. The best part about this metaphor is that it's perfect because Greeks are like the dashboard to your car. If you're driving around in your car, you don't need to stop the car and open the hood to understand how the car is working or how fast you're moving. The fuel, the engine temperature, the speed, they can tell you a lot about what's going on underneath the hood without having to stop and open it up. Greeks are the same way. These Greeks, these headline Greeks, can tell you an awful lot about how your option position is acting and where your risks are without actually having to go in and look strike by strike by strike by strike and option by option by option by option and doing all of these calculations hand by hand, because what they can tell you is what your overall risk looks like. An option position that has a lot of delta in it is going to be very sensitive to underlying movement. An option position that has a lot of gamma in it is also going to be sensitive to underlying movement, but for a very different reason, because the gamma is a different Greek than the delta is. We'll talk about both of those. The first one we're going to talk about right now is delta and direction. Option deltas, general definition, it is an option value sensitivity to stock price. These are the actual Greek letters that get used to denote delta. Most of the time people will either talk about it as the Greek letter delta, or they use a D sometimes to represent delta. But its general definition is how sensitive an option is to how much the underlying is moving. The technical definition is the expected change in the option price up or down for each $1 move in the underlying stock price. Delta is expressed as a decimal, and it can be from 0 up to 100. You can really break down these deltas into three main buckets of options. The first one, the deep in the money options. These options have high deltas. They approach a 100 delta. Now, like I said, delta is expressed as a decimal. So it'll be from 0 up to 1.00 if it's a positive number. It can also be a negative number. We'll get to that in just a moment. Or it can be expressed as 0 down to a negative 100, which would be expressed as negative 1.00. But these high delta options are approaching that 100 delta mark. At the money options, or that second bucket of options, they generally have deltas of around 50, expressed as a decimal. It'll be 0.50. These at the money options are options that are closest to where the actual underlying stock or index or the underlying in general is trading. So if the stock is trading $30, your at the money options are going to be the $30 call and the $30 put. Those deltas for those options are going to be right around 50. They might be a little bit more, a little bit less, depending on things like vol path and some other skew related issues that are a little bit more advanced. What you really need to know is that those at the money options tend toward the 50 delta. The last bucket, those far out of the money options, those have low deltas approaching 0 or 0.00. These are options that are 5 or 6 standard deviations away. They're options that have a very low percentage chance of being in the money because they have these low deltas. They could also be options that have very little time left in them and thus have very low deltas. But this is your third bucket, those far out of the money options that are approaching a 0 delta. Now, let's look at the characteristics of delta as it pertains to the two main option types, calls and puts, because delta is different for these two types of options. Calls have positive or long deltas. I'm going to say that again. Calls have positive or long deltas. They have a positive correlation to underlying stock price change. Thus, because of that positive correlation to underlying stock price change, as the stock price goes up, generally speaking, the call price will go up. That is that positive correlation at work. As the stock price goes down, that positive correlation means that the call price generally goes down as well. Call deltas can range from 0 up to 100 in a positive expression. 1.00 we would call 100 delta in kind of like professional option trading jargon, right? That's 100, we would say that's 100 delta option. When you look at this number and see that it's 100 delta option, what does that mean? Well, it means that for every $1 move, remember the definition of delta, for every $1 move in the underlying, your model expects this option to move 100 cents, basically, 1.00. And if you think about it in terms of a stock moving $1 and a call moving $1, they have a 1-to-1 ratio in that regard. And so because of this positive correlation, call deltas that get up into the 100 delta range are seen sometimes as a replacement for an underlying position, for a stock position. Why? Because they will move 1-to-1, theoretically, with the stock. As the stock moves up 38 cents, those calls should theoretically move up 38 cents. They have positive correlation to underlying stock price, and they're approaching 100 delta. Now, let's talk about the put side of things. Puts have a negative delta or short delta. So when you see deltas expressed for puts, you will see them expressed as a negative number. Puts also have a negative correlation to underlying stock price change. So everything that you just thought about as far as calls are concerned and delta, you need to flip and think about the converse of that for puts. As stock price goes up, theoretically, because of that negative correlation, the put price goes down. And as stock price goes down, because again of that negative correlation, the put price theoretically goes up. Put deltas range, again, from 0 to negative 100, expressed as a decimal here. There's another way that people sometimes think about delta, and it has to do with probability. Let's take a look at what that framework mentally is used for. Some people like to think about delta as the probability of an option finishing in the money. If you think about it in that way, you might look at a situation like this. Buying a 70 delta call could indicate this option having a 70% chance of the option finishing in the money. Selling a 30 delta call could indicate a 70% chance of the option finishing out of the money. Sometimes people look at this and think this is a little bit confusing. If you consider this as your framework for thinking about delta, as an in-the-money probabilistic kind of forecast of how things will play out, you have to consider the fact that delta is a function of the price of the option relative to things like supply and demand. And it's the market's best guess from a crowdsourced perspective as to what the probabilistic outcome of that option will be. And so in that way, some people do like to think about it this way. Buying a 70 delta call means this option has a 70% chance of finishing in the money. And that's fine. If you want to think about it that way, lots of people do, and people talk about it that way, and people manage their risk in that way as well. You need to really consider also that selling this 30 delta call means there's a 70% chance of it finishing out of the money, because these two deltas need to equal 100, okay? Buying a 70 delta call means that it has a 70% chance of finishing in the money, but it might have a 30% chance of finishing out of the money. Here's the most important part about this. In the money and out of the money does not equate to profitability. I can show you lots of different ways on my sheets from the last 20 years where I've lost a bunch of money being long in the money options, made a bunch of money being short out of the money options, and conversely as well. It doesn't have anything to do with in the money versus out of the money necessarily. It does not equate to profitability. You need to make sure that you keep that straight in your mind. In the money versus out of the money doesn't equate to profitability. Just because you have an in the money option doesn't mean it's going to be profitable. And conversely, just because you have an out of the money option doesn't mean it's going to be not profitable or profitable. Keep that in mind when you're thinking about it. Let's have a little knowledge check on Delta. Okay, so shares are trading $100 and we have 45 days until expiration. This is our little kind of matrix of calls and puts, starting with the 80 strike and ending with the 120 strike. 80s, 90s, 100s, 110s, and 120s. If an investor buys the 110 calls for $1, what is the expected option value if shares increase to 105? So there are a couple of different pieces of information we need in order to answer these questions. Shares are trading 100 now. Where do we think the stock's going? To 105. So that's up $5. Okay, so we know that the underlying's moving $5. What else do we need to know? We paid $1 for them for the 110 calls. And we need to know what their delta is. According to this, the 110 calls have a 20 call delta. Because they are positively correlated to underlying price movement, this option, this 110 call, should theoretically move 20 cents for every dollar that the underlying moves. How many dollars is the underlying going to move? $5 apparently, from 100 up to 105. If it moves 20 cents for each one of those dollars, 5 times 20 is going to be $1. Because of the positive correlation that exists between calls and underlying price movement, you should be adding that to the price of this option, theoretically. You bought it for $1, it moves up $5, 20 cents per. $2 should be the theoretical price of that option, because $1 worth of value is going to come from the call delta. If an investor sells 2 of the 90 strike puts, what is the estimated probability that the contracts will finish out of the money? I want you to look at this and think about what we just talked about as far as probabilistic kind of framework and delta. Lots of people think about delta as an option's potential to finish or probability to finish in the money. So now we're talking about what's the probability it's going to finish out of the money. Well, the 90 strike puts have a 15 delta. If you think about the fact that that would be theoretically its crowdsourced forecast as to the probability of it finishing in the money, that it would have an 85% chance of finishing out of the money. Last question. If an investor buys the 100-110 call spread for 320, what is the expected value of the spread if the shares increase to 105? Again, we're moving from 100 to 105. Stock's going to go up $5. The thing you need to understand here is that for those who don't understand what a call spread is, 100-110 call spread means you're going to be long one option and short another option. So you'd be long the 100s, short the 110s. But what that means from a delta perspective is that you're going to be long this delta, the 100 delta, and you're going to be short this delta from the 110s. So what are you going to have on? You're going to have on a resultant net delta of long 30 because it's 50 minus 20. So your call spread delta is 30, and it's positive because it's positively correlated to underlying price movement. So we're still talking about the stock moving $5. It has a 30 resultant net delta. That means you should expect $1.50 worth of value to come from that movement, that $5 movement. That's 30 cents per dollar, $5 times 30 cents. Add $1.50 to the original price of $3.20. What do you get? $4.70. Now, again, we're estimating the value. It assumes all the other factors remaining constant. Anyone who's traded options for a long time understands that there's lots of other ways that these things can move around. And so there's a lot of dynamic forces here. We are just talking about delta right now. This is if we keep all other factors constant. Let's move on to gamma. Gamma's definition. It is the delta's sensitivity to stock price. That's its general definition. Remember what I said about gamma and delta at the beginning. Delta refers to an option's value. It's how much you think the option's value should change per $1 move. Gamma refers to the option's delta. That's why people generally, when they want to talk about gamma, talk about it as the first of the second derivatives, because it's actually derivative of delta. Its technical definition is the anticipated change in the delta value for each $1 move in the underlying stock. All other factors remaining constant, gamma is expressed again as a decimal, just like delta is, just like vega is, just like many of the Greeks are. And what you're going to see when you talk about gamma is lots of people think about it as an adjustment to the delta. They talk about it in terms of how much potential energy. This is the way I think about it. Gamma is how much potential energy is embedded in the option. Only options have gamma. If you have a stock position without options, you do not have gamma. If you have options and no stock position, you might have gamma. So only options have gamma. We get a lot of questions about that as well. You need to understand that gamma is a function of optionality. Here are the three things I want you to remember about gamma. Number one is its definition. It is the anticipated change in the delta value of an option for a $1 move in the underlying stock. The second thing I want you to remember about gamma is the difference between at the money and out of the money options. Gamma is most highly concentrated in at the money options. That is because of their sensitivity to underlying movement. A $1 move in the underlying affects the at the money option with a 50 delta much more than it's going to affect its out of the money 10 delta cousin. So gamma is most concentrated in those at the money options. The other thing I want you to think about and remember about gamma is this long-term versus short-term trade-off. Gamma is, again, most concentrated in short-term options. Options that have very little time left to expiration are going to have very high concentrations of gamma. They are the most sensitive to movement in the underlying, and the reason why is because of their gamma. Options that have very little time left in them, again, are very sensitive to underlying movement because of their elevated levels of gamma. So those are the three things I want you to remember. The definition, the at the money option has the most gamma, and the short-term option has the most gamma. Let's talk about gamma characteristics a little bit. The amount of gamma that you're going to see in an option is the same for the call and the put on the same strike. This is a hard concept for some people to understand, but it's really important that you think about it in terms of the fact that if you think about gamma as the amount of potential change in an option delta, and you think about Brownian motion in general, right? Brownian motion assumes a random price distribution. And if you're making that assumption, a random price distribution in Brownian motion, the gamma should be equal for options on the same strike that give you exposure to the upside, meaning calls, and to the downside, meaning the puts. Hence, the gamma of those two options, for instance, the 30 strike call and the 30 strike put, are going to have the same gamma for puts and calls on that same strike. So gamma for calls, as the stock price goes up, the delta of that option should move up by that gamma amount. Remember, gamma is the net change in delta for every $1 move in the underlying. So as the stock price goes up, these call deltas should move up by the gamma amount. As the stock price moves down, the call delta should move down by the gamma amount. This is because, again, of that positive correlation of delta to underlying movement. And when you think about it in terms of delta is moving, how much is it moving? It's moving by the amount of gamma, by the amount of potential change that's embedded in that option. Gamma for puts is exactly the opposite. As stock price goes up, your delta should theoretically move down by the gamma amount, again, because of the negative correlation of puts and stock price. And as the stock price goes down, your delta should go up by that gamma amount. Gamma is what option buyers are paying for. Every time I talk about gamma, I talk about it in terms of embedded optionality, embedded potential change. And so when people buy options, they're buying them because they want a potential net change in that options delta. People think about it as the acceleration of delta. People talk about it as the delta of the delta, the change of the delta. I like to always talk about it as embedded potential energy in the option itself. There's two things I want to talk about right here. Gamma is always expressed as a positive number, generally speaking, in terms of the option itself. So when we're talking about options in general, we always talk about gamma as a positive number. It is what you do with those options, either buying or selling them, that creates a positive or a negative gamma of your position. The options themselves always have a positive gamma because, again, it's that potential energy that we're measuring by talking about gamma. You can't really change an option in a negative way like that. It's gamma that is changing the delta. And so thus it is actually expressed as a positive number all the time. And a lot of people, when I say that, when I teach it that way, they always say, well, I hear all these kind of people on TV talking about negative gamma exposure and price squeezes or delta squeezes and gamma squeezes that come from negative gamma exposure of dealers in options. And they're right. That's where it does come from. But the actuality of that situation is not that the options themselves have negative gamma. It's that someone walked in, took an option that has positive gamma intrinsically, and sold it to someone else. And when you sell that option to someone else, you are then incurring the liabilities of that option. And that person who buys it from you is getting all of the rights that come with that option. And thus they are also getting all the gamma that comes with that option. They're also getting all the delta that comes with that, all of the things that go with that option. But if all you do is sell options, you are going to be short gamma because what you've done is sold all of those rights and rights to someone else, and thus you have obligations. Gamma is most concentrated around short-term options because of this. The next slide is going to be gamma versus time. We're going to talk about how gamma works versus time. As expiration nears, as we get closer to expiration, gamma of at-the-money calls and puts will increase. Now, keep in mind, we just talked about how gamma is most concentrated in the at-the-money option and the shortest time frame option on the board. That's where you're going to find the most gamma out of all of those options. So as we're getting closer and closer to expiration, as we're removing time from the duration of these options, the gamma of both at-the-money calls and puts is increasing. Because of this, the gamma of both the in the money and the out of the money calls and puts is decreasing as we get closer and closer to expiration. The reason why is because we are getting closer and closer and more certain of what the deltas of these options are going to be. As we get closer and closer to expiration, we're removing a price settlement iteration out of the equation for that option. And thus we become more, or the market itself becomes more and more certain of what that option's delta is going to be at its expiration. And so you are removing, when you're removing that, you are removing the actual gamma of the in the money and the out of the money options, but you are actually concentrating that gamma into the at the money options. This is what that looks like from a graphic perspective. This blue dotted line is a 1 month option. This is a 30-day option. This is a $60 stock, 30 vol, and a 4% interest rate. Pay close attention to what this looks like. The gamma, again, as I said, is most concentrated in the at the money option and the shortest duration option. As you go farther out on the duration curve, you'll see that the option's gamma gets less and less and less for the entire curve of those options. Now, you'll also see that the actual curve itself becomes flatter and flatter and flatter as you get time put into the, as you increase the duration of the option. The reason why here is because as you get farther out in time, if we're talking about an option that has 18 months in it, we have less certainty about whether or not the $60 call is going to be in the money versus the $80 call. And as you blow that out in time, like way out in time, a 10-year option, I couldn't tell you whether the $60 call or the $600 call has any difference in its delta, because it's got 10 years of price iterations in it, or the $6 call for that matter. And so as you add time to options, the options themselves along that skew curve start to have very similar actual properties to them as far as their gamma, their theta, their vega. Like they all start to look more and more similar because we have less of an idea of which options are going to actually be in play at the time of expiration because we have so much more time in them. So the thing that you need to remember as far as gamma is at the money options have the most gamma and short-term options have the most gamma. Those are the two things I want you to remember. Knowledge check for gamma. Shares are trading $50 and we have 10 days till expiration. Here's our price matrix. 48s, the 49s, the 50s, 51s, and 52s. These are your call deltas and these are your call gammas for these options. We have 10 days till expiration. If you were to buy the 50 calls and the shares increase $2, what's the new expected delta? What do we need to know? We need to know how much is the underlying going to move, what was the call delta to begin with, and how much gamma is going to change that delta per $1 move. We're starting at $50. We're buying the 50 calls. They start with a 51 call delta and they have a 12 call gamma. That means it's going to move 12 deltas per $1 move in the underlying. This is a call, so it has positive correlation to underlying price. We're starting with a 51 call delta. It's going to move up $2. That's 12 cents of delta per $1 move. That'll be 24 deltas total for the move. 51 plus 24. Last time I checked, yep, it's still 75. So the 75 will be our new delta for those 50 calls with the stock trading 52, theoretically, as far as this model is concerned. If an investor was short the 50 calls with the stock trading 50, would a share price increase to 52 result in an increase or a decrease in gamma? What do we need to know about this to answer this question? We need to know, where is gamma the most? Gamma is the most in at-the-money options and short-term options. Well, we don't have any indication as to duration here, but we do have an indication as to whether or not this option is at the money or not. The $50 call with the stock trading 50 is the exact at the money option. Where is gamma most concentrated? At the money. So right now, with it trading 50, you're short the 50 call that has the most gamma on the board. Would a share price increase to 52 result in an increase or a decrease in gamma? Well, after the stock moves to 52, what option is going to have the most gamma on the board? The 52 call, not the 50 call, which means that your option, when the stock moves away from at the money, is going to actually decrease the gamma of that option. If a trader's long 10 of the 52 calls and shares increase from 50 to 51, how many shares would they need to buy or sell in order to remain delta neutral? For those who don't know, delta neutral positions are positions that have options in them, and then they have a counteracting stock position that is in the opposite direction, delta-wise, that keeps your delta exposure to net zero. In this case, you have 10 of the 52 calls in your position. The 52 calls have a 29 call delta, which means that your total call delta from your options for 10 of these is going to be 290, which means when you start off to get to a zero delta neutral position, you're going to be short 290 shares of stock against this position. When the stock goes from 50 to 51, how many extra shares are you going to need to sell in order to remain delta neutral? Well, where do we look for that answer? Right here. The gamma of this option is 10, which means as the stock goes up by $1, stock's going from 50 to 51, this option that had a 29 call delta to begin with is going to have a 39 call delta at the end of that dollar move, and you have 10 of them. So you're going to have 390 deltas in options, but you're only going to have, remember, 290 shares of stock against it. So in order to be delta neutral, you're going to have to sell an extra 100 shares of stock to get you to 390 total shares, which would equal your call delta from these 52 calls after that dollar move. Again, 3 things I want you to remember about gamma. The definition itself. It's the anticipated change in the delta value of an option for a $1 move. Always remember, gamma is most concentrated in the at the money option because of their sensitivity to underlying movement. A $1 move in a 50 delta option makes a much bigger deal than a $1 move on a 10 delta option. That's why those at the money options have the highest concentration of gamma. And then the third thing is long-term versus short-term options as far as duration is concerned. Gamma is most concentrated in short-term options. The shorter the time frame that you have to expiration, the higher propensity for gamma that you have embedded in that option. Let's move on to theta, the last Greek we're going to talk about today. Option theta is also referred to as time decay. It is, in general, an option value sensitivity to time. What I said at the beginning of this is basically, what does theta mean? Theta means that when you fast forward your clock 24 hours, the value of your option should theoretically move by its theta. It is expected time decay in option value per 24 hours of time. It is the passage of 1 day, 24 hours. It's expressed as a decimal. In this case, this is going to say that we have 8 cents of theta. That means that if your option's worth $1 today and it has 8 cents of theta, and you roll your clock forward 24 hours, that option on your sheets, according to your theoretical framework, should be worth 92 cents tomorrow, 8 cents out. This is important. Decay is per calendar day, not per trading day. We get a ton of questions about this. Expected time decay in option value happens per calendar day and not per trading day. It represents a cash amount per option, and all other factors remaining constant. Calls and puts both have negative theta amounts. Theta is expressed generally as a negative number because it is a decay function as far as time is concerned. Here's a couple of things I want you to remember about theta. Theta doesn't care if the exchange is open, or if the stock is halted, or if it's a weekend or a holiday. If you're long options, your options will theoretically decay on a daily basis. However, there are many factors that can counteract that decay. The first is movement. Underlying movement can counteract a lot of theta decay. When stocks are moving around a lot, it's very hard for people to forecast exactly what an option is going to be worth. And thus, it's very hard to remove theta from those options on a daily basis because the people who are making option prices don't necessarily know what the options are going to be worth in really high volatility environments. In a situation like that, you can see things like implied volatility levels rising, and thus you can see that counteracting the forces of theta more generally. So people will say, these calls are worth more than they were yesterday, but the stock didn't move. What happened to my theta? Well, the answer is technically your theta did come out, but implied volatility got raised by more than the theta. And so the call's worth more than it was yesterday, even though the stock didn't move. So you need to remember that there are other dynamic forces in there, and theta is not something that is guaranteed to come out. It is a theoretical construct that gives you an idea for what it might happen to the valuation the next day. The next slide, we're going to talk about a real world example of how you might see theta work in the real world here. An options trading today, $3.50. It's got a theta of 3 cents, 0.03. Again, expressed as a negative number, and it's a decimal. The contract right now is worth $3.50 times 100 shares, or notional value of $350. Expected value tomorrow on your option model is the $3.50 is worth now. 3 cents of theta, theoretically coming out in the next 24 hours, should be $3.47. What does that equate to? $347 per one lot. You can see how theta works here. That's 3 cents of theta, or a $3 loss per contract per day. If you were to actually run this out 10 days, an expected value for a 10-day move from now might be something like $3.20. Why is that? Well, it has 3 cents of theta. And theoretically, if you think all 3 of those cents are coming out in each one of those 10 days, 10 times 3, it's going to give you 30 cents. We started at $3.50. That option might be worth $3.20 if you assume everything else remains constant. Now, the 10-day forecast is not always accurate as far as theta is concerned. But what I do want to talk about really quickly is how time decay, as far as theta is concerned, is not always linear. This is a great example of saying 10 days from now, this option is going to be worth $3.20 theoretically. And yes, if the theta were 3 cents for each one of those 10 days and the theta came out every day, yeah, sure, that option would be worth $3.20. In real world terms, the theta changes from day to day because of things like time left in the option. Time decay is not linear. Here's what I'm talking about. This is a graph of the time value of your option versus the time left in the option. You'll see this is obviously not a linear function. It has curvature to it. The overall rate of time decay is exponential as we get closer to expiry. The difference here is the at-the-money option has this exponential time decay. This is your in-the-money option decay. It's much more linear. It's not perfectly linear, but it's much more linear. And the reason why is because at-the-money options are comprised almost exclusively of extrinsic value. When you're talking about time decay, as far as time is concerned, the part of the option that's actually decaying is the extrinsic value, not the intrinsic value. In the money options have a large proportion of their value in the intrinsic value and not in the extrinsic value. And so they decay at a much more linear function. But these at the money options decay almost exclusively in their extrinsic value, and thus they accelerate as we get closer to expiration. Lots of people say, well, when does it start to accelerate? Generally speaking, it's around that 1 month to 40 days is when you'll start to see this exponential kind of function start to kick in, but you'll really see it go exponential that last week generally of trading is when the theta numbers really start to kick up a notch. So this is your theta amount over time and the time left to expiration. You can see how at the money options have that exponential decay function. I want you to consider one thing really quickly. 100-day option. Think about a 100-day option and think about removing 1 day of theta out of this option. What you're really doing is removing 1 day of price settlement iteration from the underlying, from the value of the option. That doesn't comprise a significant portion of that option's value if it has 100 days. You're talking about taking 100 days down to 99 days. Now, I want you to contrast that with an option that has only 5 days left to expiration. And thus, it only has 5 iterations of price settlement left in the underlying. If you are to remove 1 day of that price iteration and thus the theta that comes with it, you're taking 20% of the actual probabilistic outcome of that option out of its value. That's a huge difference between a 5-day option removing 1 day of theta and a 100-day option removing 1 day of theta. And thus the theta is commensurate with the percentage of the value that you're removing out of that option, that 5-day option or that 100-day option. So think about those two things as far as how much of that value of the option you're removing on a daily basis when you think about theta. Knowledge check for theta. Shares are trading $100. You are long the 95.90 put spread for 50 cents. Does theta help or hurt this position? The only thing you really need to know about this is that you're long premium. Long the 95.90 put spread, you paid 50 cents for it. The 95s, because you're trading $100 or closer to at the money, these are going to be bigger options than these are, these 90s. You're long the spread for 50 cents. Options generally decay over time. Theta is going to hurt this position because you're long premium. You're long the 80 strike calls for 20 and a quarter or the 85 strike puts for 40 cents, which is more affected by time decay? This is a great question. You need a couple of pieces of information here. The shares are trading $100. So this 80 strike call is 20 full dollars in the money. So of this 20 and a quarter, 20 full dollars of it are what we said intrinsic value. That's not really going to decay at any kind of function. The 85 strike put is fully out of the money and is 40 cents. This is completely extrinsic value. How much of this value is extrinsic value? Just this part, the quarter. So when you look at this, you see, well, this has extrinsic value of 25 cents. This has extrinsic value of 40 cents. We've got a couple of days left to expiration. The time decay is going to affect the larger option more. Those 85 strike puts are going to be more affected by time decay. Stocks trading 50 and you're long the April, March 50 calendar spread. Does theta help or hurt you? This is something that relies on people understanding, obviously, what a calendar spread is. A calendar spread is being long 1 month and short another month. So in this case, April, March, you are long time here. You're long the longer dated option and short the shorter dated option. Does theta help or hurt you? What you really need to understand is which one of these options is going to decay faster. Is it the long dated option or the short dated option? And the answer is the short dated option is going to decay faster. So you're going to be long the option that's decaying slower and short the option that is decaying faster. Theta is going to actually help this position. Things I want you to remember about theta. It comes out on a daily basis. Theta doesn't care whether or not the exchange is open. It can be replaced by elements like movement and the resultant delta that comes with that movement or implied volatility. But the theoretical theta function exists every single day, no matter what. It can be replaced by other factors that are dynamic, but theta happens all the time. The other thing I want you to remember about theta is it is greatest in the at the money options, and it increases exponentially as you get closer to expiration. Remember that concept of curvature of the at the money option versus the in the money option decay function and their respective decay what the curves look like as far as their decay functions are concerned. One has curvature. The at the money option has a lot of curvature to it. The other one is almost linear in nature. So we've covered a lot of ground. I came in right at an hour, Ken. I don't think we're going to have a lot of time for Q&A. If you guys want to reach out to us, please make sure that you check out optionseducation.org. Right here is our URL. This is where we host all of our educational content. Again, you will find all kinds of things here: courses, podcasts, webinars, all kinds of things that are really, really great resources for people, even people who are really advanced as far as options trading are concerned. But it has a whole host of educational resources that are all centered around options at optionseducation.org. And then make sure you send us emails at options@theocc.com. This email address goes to the investor education desk, where I sit with 3 of my other fantastic colleagues, Mark, Ken, and Roma. And we will answer your question the day of if we can at all. And generally speaking, everybody gets answers from a real live person with real life trading experience. Again, we are not registered investment advisors, but we love to help in whatever way we can to really supercharge your knowledge base as far as options are concerned and make sure you understand how options work generally. So I think with that, we are out of time. Thank you very much for joining us today for the Greeks 1, Delta, Gamma, and Theta. Make sure to tune in next week on the 15th, same bat time, same bat channel, 3:30 Central Time. We'll be talking about the Greeks 2, which will be Rho, Vega, and the second order Greeks. It'll be more of the same, but we will dive really deep into implied volatility and Vega, Rho, and those second order Greeks. So thank you very much for joining us today, and we'll see you next week.